This video will help you understand how a donor-advised fund works, as well as some of the tax benefits in using them, ultimately so that you can decide if it's a good fit to incorporate into your charitable endeavors. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. A super common concern as folks start to accumulate more and more resources is how best they're going to maximize these resources, and one of the most common methods is through the use of charitable giving. And while there's a number of different ways to gift to a charitable organization of the client's preferred choice, one super common method of both getting a large tax deduction as well as supporting charitable organizations in future years is through the use of a donor-advised fund. So in today's video, we'll walk through how a donor-advised fund works. We'll talk about the tax benefits, how to maximize them for your situation, and then we'll talk about some best use cases. So let's jump in. There are an infinite number of ways in which you can assist a charitable organization. You can give your time, you can give your resources, you can give your connections. You might be able to impart your experience by sitting on the board, for example. Or lastly, you could also look to gift money. Of all the different ways you can gift to a charity, the only one that actually comes with tax benefits, however, is through the gift of money. There's two primary methods of gifting money that I see, and that's through the gift of cash or non-cash, specifically though, securities. Now, there's pros and cons of gifting either one of these types of assets, and they actually come with different tax ramifications. And by no means are these two resources the only exhaustive methods of giving money. Theoretically, somebody could gift real estate, they could gift business interests, they could gift collectibles or artifacts or art, or clothing or vehicles, etc. The list is near infinite. And if you're curious to know, you could always refer to Form 8283 that actually lists out some of the more common things you can gift to a charitable organization. But the most common ones that I run into and that I help clients plan around are going to be cash and securities. So we're going to narrow our scope to gifting one of those two types of assets. Now, as it pertains to actually moving these assets from your balance sheet to the charitable organizations, there's a number of different ways you could do that. The most common one that people hear about are direct transfers. And for example, that's where you stroke a check to a charity and you give them the check. And then on the far opposite side of the spectrum of complexity, you've got things like gift annuities, charitable lead trusts, you've got charitable remainder trusts, you've got the establishment of private foundations, etc. Now, we don't have time to get into each one of these different methods of gifting. They're a little bit advanced, but I would argue a donor-advised fund falls right in the middle of that complexity spectrum. They're not as simple as just stroking a check and walking away, but they're also not as complicated as needing to enlist the help of an attorney or to draft any special contracts with the charitable organization. A donor-advised fund basically functions as a charitable investment account that you make contributions to, you receive immediate tax benefits, and the money within that donor-advised fund can be invested, grow and compound, tax-free I might add, and then can be doled out in the future in an ad hoc fashion of the client's choosing. And you don't have to decide which charitable organizations are going to benefit from your donor-advised fund until you're actually looking to provide those grants, which is the charitable term for distributions out of that account. The reason a donor-advised fund works to permit a client to take an immediate tax deduction, even though the intended charitable organizations haven't received the money yet, is because the company that runs the donor-advised fund is actually its own 501c3 tax-exempt organization. One of the reasons donor-advised funds are a little bit higher on the scale of complexity than just, again, giving cash straight to a charitable organization is because there's a little bit of due diligence that needs to happen. Number one, each donor-advised fund platform is going to have its own myriad of administrative expenses. If there's an advisor involved, there could be investment management expenses, or the securities themselves within the donor-advised fund are going to have their own investment expenses. Not to mention the user experience with some platforms is going to be better or worse than other user experiences with other donor-advised fund platforms. And some platforms are going to have minimum investment contributions, some are going to have minimum balances that must be maintained in the plan, and some platforms might have a minimum grant size that if you're going to ask them to send money to an organization, has to be a sizable amount enough to make it worth their time. So it's important to know what all the minimum and administrative requirements are for a particular donor-advised fund platform. And then lastly, while there is no IRS mandate that the money in the donor-advised fund actually ever get doled out, by a particular time frame, the donor-advised fund platform themselves might have minimum requirements such as of the total balance, you must distribute 5% every single year. This helps them avoid IRS scrutiny as not necessarily providing like a bona fide charitable goal. And donor advised funds have, like any tax tool, been used and abused in the past and could suffer from some IRS scrutiny if they don't seem to be operating on the up and up. Now, quick side note, a donor advised fund is not to be confused with a designated fund. A designated fund is a targeted charitable investment vehicle that usually only provides resources for one charitable organization, whereas a donor advised fund has a lot more flexibility as to where their money is going to be sent to. A designated fund generally requires either ongoing contributions or a commitment to ongoing grants to that organization from the fund itself. Now, they provide the same tax benefits as a donor advised fund, they're just a lot less flexible and a little bit more targeted. A quick thing to know about designated funds is if you are someone that does qualified charitable distributions or gifting straight from your IRA, the only type of fund that you can use is a designated fund if you don't want to outright send that money to the charitable organization directly. Said another way, you can't use your qualified charitable distribution check and send it to a donor advised fund and receive the same tax benefits. But you can send that check to a designated fund. So why would somebody use a donor advised fund and not just give money directly to a charitable organization? Well, the immediate tax benefits are actually the exact same, whether you gift the money to a charitable organization directly or if you invest that money into a donor advised fund. And we'll touch on those tax benefits in a little bit. But one of the biggest reasons why you might choose to invest or donate to a donor advised fund as opposed to directly to the charitable organization is whether or not the charitable organization can actually accept your gift. Now, if it's cash, cash is king, everybody can take cash. But if you're going to give securities or business interests or potentially even illiquid securities, a charitable organization might not have the capacity to accept that donation. It's probably not too far-fetched to think of your local church, for example, that has one head pastor and maybe one administrator. Gifting them cryptocurrency probably would be a little bit challenging for them to receive and then know how to handle that. They'd have to hire someone to set up an investment account for the church and find ways to liquidate that investment. It's probably a little more complicated than their capacity can handle right now. Now, I do imagine, however, that like mega churches could probably handle that gift, but one of the big values of using a donor advised fund is they can accept pretty much any type of investment security. Another big advantage of using a donor advised fund is if you have a particularly large income tax year and you want to make a particularly large tax deduction, but you're not quite sure if you have decided which charitable organization you want to either receive all that money or portions of that money, well, you could gift to a donor advised fund, benefit from all the tax deductions in the current tax year, and then in subsequent years decide which charitable organizations are going to get those proceeds. You don't have to make the decision when you donate. Also, as a side note, from an opportunity cost standpoint, the faster we can get money into a tax sheltered environment like a donor advised fund, the longer that money can grow and compound without taxes. And dollar for dollar, money inside of a donor advised fund versus money inside of a brokerage account, the donor advised fund money mathematically would grow more efficiently because there's no tax drag like capital gains or interest income or dividend taxes, etc. Another cool feature of a donor advised fund are for those of you who are looking to impart on your family your philanthropic objectives and teach the next generation about causes you care about. Well, by giving to a donor advised fund and establishing the fund, having it grow and having it dole out grants in subsequent years, it's absolutely something you could rope the next generation into, where maybe annually you as a family decide which organizations are going to benefit from your donor advised fund. In addition, if you're trying to teach the next generation about security selection or investment management, this type of account doubles as both a philanthropic objective identifier for the family, but then also teaches the kids how money grows and compounds and how to make smart long-term investment decisions. One last benefit to using a donor advised fund is the administrative simplicity. Now, I know what you might be thinking, wait, I thought you said this was a little bit complex. And while it is, administratively, however, when you gift to a donor advised fund, you have one transaction you need to track for charitable donation purposes. Whereas if you were to instead gift directly to 10 or 20 different institutions, you'll need to track those 20 different contributions and get 20 different receipts, and then report all 20 different transactions on your tax return. Whereas through the use of a donor-advised fund, there's just one transaction, and the fund is responsible for tracking all the other subsequent grants that it makes. And for those of you who are helping maybe the older adults in your life, this is a huge value add, because as folks get older, a lot of times tracking all these things just gets more and more challenging, and the use of a donor-advised fund can make things very simple. Now, there are downsides to using a donor-advised fund. We already talked about all the potential fees and scrutiny and ongoing investment management that you'll have to deal with. Another downside is if you are looking to support a charitable organization immediately in the current year, well, the donor-advised fund really isn't going to be valuable for you. You're going to do all that work in scrutinizing the best custodian to help you or the best provider. But ultimately, if you're just going to put money in to then have it get granted out immediately to a charitable organization, well, you're missing the value of the tax-free accumulation within the fund. So if an organization needs immediate help and you're willing and able to provide that help, a donor-advised fund just might be an extra hoop to jump through. And lastly, I would say a donor-advised fund sort of sets you up for the requirement of ongoing management and administration. Yes, you can delegate this to an advisor and they should be tracking all this for you, but it is just one more thing you'll need to keep tabs on, especially if you're trying to kind of DIY your financial plan. Whereas gifting to an organization directly, as soon as the money's gone from your account, the transaction's over. Let's briefly touch on the tax benefits afforded to you were you to donate to a donor-advised fund. Now, we don't have time to get into all the nuanced gifting limits and deductions that apply to anybody who's making charitable contributions. In addition, there's some changes for 2026 moving forward, given some provisions in the One Big Beautiful Bill. We'll have to cover that in a subsequent video. To keep it simple though, for 2025, as far as maximizing the value from a tax perspective on using a donor-advised fund, first and foremost, if you want to benefit from the current year tax deductions on funding a donor-advised fund, you must itemize your deductions on your tax return. Now, 91% of Americans generally take the standard deduction, meaning they do not itemize their tax deductions. So if you're used to taking the standard deduction, this is going to be a little bit of a paradigm shift. Despite what social media tells you, just because you give money to charity does not necessarily result in a tax deduction. You have to also then go choose to itemize your tax deductions as opposed to taking the standard deduction. And the most recent One Big Beautiful Bill increased the standard deductions for all Americans, especially those 65 and older. So the value of taking itemized deductions over standard deductions is probably going to get even less. That being said, until tax laws change, you must itemize tax deductions if you want to take advantage of charitable deductions. Other itemized deductions would include things like mortgage interest deductions, state and local taxes, also called SALT deductions, and then medical expenses if they are above a certain threshold of your AGI. And we'll come back to AGI, which stands for Adjusted Gross Income, in a minute. Now, I understand the primary purpose of gifting to a charity is not for the tax benefits. It's a nice add-on, but primarily we're gifting for charitable reasons. That said, to be mindful of how to maximize the tax benefits on your charitable giving, you're going to need to know which limits to play within. For most people and most donor-advised funds, your contributions and their subsequent tax deductions on your return for the current year are going to be limited to a percentage of your adjusted gross income. Your adjusted gross income can be found on line 11 of your Form 1040 or your Form 1040 SR for seniors. If you're choosing to donate cash directly to a donor-advised fund, the maximum cash tax deduction you're allowed is a cash contribution of 60% of your adjusted gross income. Said another way, if your adjusted gross income for 2025 is $500,000, though you could gift more, the maximum tax deduction you'll receive on contributing to a donor-advised fund is $300,000. So if you give less than $300,000, and let's say you give $250,000, well, $250,000 is now your deduction. If you gift more than $300,000, say $350,000, you're only allowed to deduct $300,000. Now the good news is you can carry forward that additional $50,000 of unused tax deduction due to your charitable contribution. You can carry forward that for 5 future years. But if your AGI is too low in the future, or you keep making sizable gifts in the future and you end up never using this $50,000, well then it's just going to expire after 5 years of tracking. If you choose to donate non-cash assets, which the IRS refers to as capital gain assets, and I'll just call investment securities that you've held for longer than a year, your maximum tax deduction is going to be limited to 30% of your adjusted gross income. So again, if your adjusted gross income is $500,000, your maximum tax deduction were you to donate securities will be limited to $150,000. And the value of those securities is based on the fair market value of those securities, not on the basis or the amount you paid to get those securities. We'll touch on this difference in a minute. But ultimately, again, if you were to gift more than that 150 grand worth of fair market value securities to a donor advised fund, that's all well and good, and you'll eventually be able to help all the organizations you care about. You just won't be able to take that extra tax deduction in the current tax year. Again, though, you can carry that forward for the next 5 years. Keep in mind, you'll once again be limited to only using 30% of that additional deduction towards future years on future year AGI. Last circumstance is if you're choosing to donate both cash and securities. Well, the 30% of AGI for donating securities rule was a little bit simplistic because technically the rules say you can gift the lesser of these two amounts, either 30% of your adjusted gross income in securities or 50% of your adjusted gross income in securities minus however much you gave in cash. So without getting into all of the math for circumstances like this, to keep it super duper simple, if you donate 30% of your AGI in securities, then you could donate 20% of your AGI in cash and maximize the amount of tax deductions you could qualify for. It's sort of a shorthand cheat code of how to maximize the deductions when you have both a plethora of securities and cash to choose from. Now, if you have no cash and all securities, well, you're limited at 30%. And if you have all cash and no securities, well, then you could totally donate 60% of your AGI in cash and receive the full itemized tax deduction on that. So for example, if you have a $500,000 AGI and you donated 150 grand worth of securities, then you could donate 100 grand worth of cash and maximize your tax deduction at $250,000. So which securities should you look at gifting? Remember I said we'd come back to the basis versus gain. Well, since the donation is based on the fair market value of the securities you're donating, generally best practice is to look to contribute to a donor advised fund the securities in your portfolio that have the highest level of appreciation. Because were you to sell those securities and generate income to live off of, or sell those securities so that you could rebalance your portfolio, you would just otherwise have to eat all the taxes embedded in those capital gains. And for those of you who live in Washington state, those capital gains could get hit with an additional 7 to 9.9% in Washington state capital gains tax. And that's not even to mention the federal net investment income tax, which I'll link above to explain our videos on those. So general best practice, the consensus is to donate highly appreciated stock, and or for those of you who are in charge of managing an investment portfolio, maybe sending to the donor advised fund the securities that you are planning to sell out of so that you can diversify, rather than rebalance that way. Before eating those taxes, maybe just send those securities to the donor advised fund. Now your portfolio is rebalanced and you do not have to eat those capital gains taxes. So from a calls to action standpoint, I would analyze your financial plan relative to your charitable giving strategies and see if a donor advised fund can make sense. If you've never thought about how you're planning to gift money to charitable organizations, well, of course, you have no obligation to do so. If that is something you are considering, a donor advised fund can oftentimes be a great first couple steps into the water before diving in with maybe some more complex strategies. So hopefully that was helpful. If you have further questions, I'd say drop them in the comments, but we had to pause those for now. Feel free to get in touch on my other social medias or send us a message through the website directly. And if we can't help directly, we'll at least point you in the right direction. Have an awesome rest of your week, and we'll talk to you later. Bye.